tax reduction strategies used by the wealthy. In this episode, I'm going to address the question, what is the best way to reduce taxes? It's probably not what you think, so get ready. I'm going to enlighten you on what wealthy people do and also what members of Congress do to avoid paying unnecessary tax. So my name's Doug Andrew, and I've been a tax strategist helping people redirect otherwise payable taxes to causes they support for more than 4.5 decades. I've helped many people prepare for a comfortable retirement where they do not outlive their money by making sure that 40 to 60% of their retirement income is tax-free. That is not in traditional vehicles like IRAs and 401ks. So I'm going to start out and share with you 3 sections of the Internal Revenue Code that have been in the code for over a century in one form or another. It's like a sacred tax-free cash cow, and I'll explain why is it tax-free and who utilizes this instrument allowed in the Internal Revenue Code to be able to grow their money tax-free and later on be able to access the money for retirement income or any other purpose without having to pay tax on the gain. Are you ready? For over a century in the Internal Revenue Code, currently the sections are 101A, 72E, and 7702. Now, I've helped teach CPAs and tax attorneys these 3 sections of the code for years. Unfortunately, they do not need to understand these thoroughly to get their LLM degree. That's a master's in taxation. And so they call this advanced continuing education. But don't fret, I'm going to simplify it. In section 72E of the code, this allows people to be able to grow or accumulate their money tax-free in a life insurance contract. Now, before you say, what? A life insurance policy? I've never seen a life insurance policy that earns very much money. You haven't seen one designed to do what I'm going to show you here, because this was actually the brainchild of E.F. Hutton, who was not an insurance company back in 1980. They were a brokerage firm. And they realized in these 3 sections of the code, there's only one financial instrument that allows you to accumulate your money tax-free under 72E. But under 7702, you can access your money. You can take money out and it stays tax-free. People say, you mean like a Roth? Sorta, but it has a lot more benefits than a Roth has. So 72E allows you to earn interest, dividends, grow your money tax-free. I've actually doubled my money about every 7 to 10 years by using max-funded indexed universal life insurance. And so all the growth is tax-free under this section of the code. 7702 means I don't have to wait till I retire. Anytime I can access money tax-free. If I'm a business owner, I could put $300,000 into this insurance contract. And if I needed $250,000 out 30 days later, I access it. There's no penalties. It's totally tax-free. It's extremely flexible. That's provided under 7702. You do not incur the penalties from the IRS or trigger tax when you access money like you would if you tapped into an IRA or 401k before the age of 59 and a half. You have to borrow and pay it back or else you have to pay tax. Now that brings us to 101A. Now, I've said this on other episodes. None of us are getting out of here alive. I mean out of this life, okay? And so we're going to pass away someday. Whenever we pass away, money inside of the insurance contract will transfer tax-free, but it blossoms. What I mean by that, it increases in value. If my objective by owning an insurance policy is to use it for living benefits, primarily, instead of the death benefit, then what you're doing is you're structuring an insurance policy with the least amount of death benefit the IRS will let you get away with, and you're putting in the most money the IRS allows as fast as they allow. These are provided over here that I'm going to explain next. This turns it into a tax-free cash cow, and I can set aside money in this instrument rather than an IRA or 401k and accumulate my money tax-free. I've had business owners who put in $500,000 and $500,000 doubles to $1 million in 7 to 10 years. It doubles to $2 million in another 7 to 10 years. And then to $4 million, then to $8 million. We have many clients who have $8 million now, 30 years later, and they started out with $500,000. They didn't add any money to it. It just grew tax-free. But when they finally die, okay, every million that I would have in my insurance policies, if I died tomorrow, and maybe I will, I don't know, I'm 69 right now, would blossom to about 2.5 million and transfer tax-free because the cash in there becomes part of the death benefit and it transfers income tax-free. Now, nothing else in the Internal Revenue Code does that, and E.F. Hutton said, golly, why don't we use this for living benefits? Instead of trying to get X amount of insurance for the least premium to pay off in case we die, let's flip it and let's use it for living benefits. Let's take the least amount of insurance. So at age 60, let's say, if you wanted to set aside, $500,000, you could do that, and the least amount of insurance is $1,250,000. You could buy way more life insurance than, $1,250,000 with $500,000. I mean, when E.F. Hutton came out with this idea, the IRS said, wait a minute, what are you doing? And they actually took him to court, and they weren't doing anything wrong. E.F. Hutton won. But the IRS is like, well, who pays $500,000 for $1 million of life insurance? And Hutton said, well, our clients do, because they're using it for living benefits. They're self-insuring. They put in $500,000 to $1 million policy, and the net amount at risk is only $500,000. And so as the money grows, pretty soon you're self-insured. It's the best way to buy term and invest the difference, because you're self-insured. Your cash will usually exceed the death benefit maybe as soon as 12 to 15 years into the policy, because you're trying to put in the most money as fast as they allow. Long story short, let me tell you what happened. Now, before I share these tax citations on the right, if this is intriguing you, make sure you share this video. A lot of people don't know what they don't know because you can't be aware of something you're not aware of. Click like, post a comment, but subscribe. And click the little bell there, which will notify you every time I post a new video, which I do almost on a daily basis, answering a financial question. And stay with me to the end, because I want to gift you my most recent best-selling book, The Laser Fund. Don't pay retail of $20. I want to gift you a copy, okay? So what happened is back from 1980 to 1982, after the IRS went to court and E.F. Hutton won, and the IRS approached Congress and said, we got to change the definition of tax-free under these sections of the code, because we think you're violating this. And so if you move out from this tax-free umbrella in these 3 sections of the code, it'll move over to a taxable section called investments. So this is not an investment. We don't want to call it an investment. Investments are taxed sooner or later, and they're usually subject to market volatility. I don't want either one of those. So I don't want it to be deemed an investment. What is it? It's an insurance contract that is tax-free. And so in 1982, under the Tax Equity Fiscal Responsibility Act, it spells the acronym TEFRA, the IRS said you have to have a commensurate amount of insurance attached to the account in order to qualify as tax-free insurance under these 3 sections of the code, even though the primary purpose is for living tax-free accumulation and income, okay? Now, you may be surprised here, but they didn't quite know what they were doing. I'm talking about Congress, even though congressional people actually own these. And so in 1984, under the Deficit Reduction Act, that's DEFRA, they redefined it again. This is called the TEFRA-DEFRA corridor, and it simply dictates the minimum amount of insurance that has to come along for the ride, so to speak, so that your money will accumulate tax-free and you can access it tax-free for living benefits under these sections of the code. You don't move over to the investment section of the code that's eventually taxable, okay? And so that's TEFRA and DEFRA. The neat thing about TEFRA and DEFRA is it gave parity, meaning it didn't matter if you were a 22-year-old athletic marathon running female, or a 60-year-old, or an 80-year-old friend of our family who had 3 blocked arteries, adult onset diabetes, and a prostate cancer episode. He had 6 sisters predeceased him and 3 brothers. He was able to get an insurance policy and earn 11% at the time and net 10, cash on cash, just like a 60-year-old, just like a 22-year-old. Because the amount of insurance required under TEFRA and DEFRA goes down the older you are and the more unhealthy you are. And if you're totally uninsurable, it's the owner of the insurance policy that gets all the tax-free accumulation and tax-free income. So if you're not insurable, you can own one of these on your spouse, your kids, your grandkids. These are called surrogate insureds. That's TEFRA and DEFRA. There was this massive exodus of money leaving the banks, the brokerage firms, the credit unions from 1984 to 1988. And so they couldn't compete. These were safer, they paid higher interest, they were tax-free, they blossom when you die. And so they wanted to slow the flow. They didn't want to kill these because this is where banks will put some of your money. Did you know that? Banks, for the last decade or two, pay us a measly 1%. Every million we deposit into a bank, and they pay us 1% interest, that's $10,000 a year they pay out in interest. They turn around and put 30 to 40% of their tier 1 assets for liquidity and safety in insurance companies. Sometimes it's called BOLI, bank-owned life insurance, BOLI. Corporations do this, it's called COLI, corporate-owned life insurance. They earn 5% tax-free without even linking to an index. How much more is 5 than 1? 500%. They're making 50 grand, they only paid us 10 grand. They're making 5 times what they're paying you, and they're increasing the safety on the average by 6 notches higher. Most banks might be rated triple B on the average. Most of these insurance companies where I put my money are rated AA, AAA, okay? So they're increasing the safety and the rate of return. Are you getting it? You can bypass the middleman. They wanted to slow the flow. June 21st, 1988, they said, you can't put in all your money all at once. They didn't want to kill it because this is where they put their money. This is where a lot of congressmen and women put their money. So what do they know that maybe you didn't know? So in review, before I show you how this all comes together, TEFRA and DEFRA talk about how much insurance has to be attached to the account in order for it to be qualified to be tax-free and not move over to the investment section of the Internal Revenue Code that's subject to tax. When the Technical and Miscellaneous Revenue Act was passed in 1988, it related to Section 7702. How fast can you put in the money? And so I often compare this to like a bucket. So a maximum funded indexed universal life is the best way I know of to reduce taxes. I've helped many, many thousands of people dramatically reduce their taxes. We took a couple in California from the highest tax bracket to a 0% tax bracket in 5 years. We had another couple in California, a husband and wife physician. We moved 120,000 of their 200,000 of retirement income totally off of their 1040 tax return by putting it into a portfolio of these buckets. The bucket is the universal life insurance policy. You design the bucket to accommodate the amount of money you want to put in. If you want to put in $500 a month, $10,000, $500,000, you design it to hold $500,000. All of the interest you're earning is tax-free under Section 72E of the code. Now, the amount of insurance is not free. It's this spigot here on the bottom. And this is actually watering a nice little money tree here that at the end of the day is going to blossom when you pass away. Because if I put in $500,000 and I die the next day, it's going to pay out $1,250,000. But that $500,000 is going to double to $1 million. And now the net amount at risk, that spigot is only draining out the cost of the remaining $250,000 at risk because I'm self-insuring. $500,000 goes to $1 million. $1 million doubles to $2 million. The original death benefit might be $1,250,000. I now, am self-insured. The spigot on the bucket is minuscule. I'm earning rates of return of 11 and netting 10.5%. TEFRA-DEFRA dictated the minimum amount of insurance. If I'm 60, that might be $1,250,000. I put in $500,000. I don't have to put it in all at once, but it's going to grow. Under TAMRA, I might only be able to put in $100,000 or $125,000 a year in 4 years or 5 years. And now it turns into this tax-free cash cow. This is where savvy, wealthy people put their money for long-term goals. This is where many congressmen and women put their money. You can do this too. You want to learn how? So if this is intriguing you and you want to learn how, I want to gift you this book. I'm big into education. This isn't about me. This is about you and your brighter future. If you want to learn how to get 40 to 60% of your retirement income off of your 1040 tax return, the IRS will know you're receiving the money, but they'll know it's tax-free because it's been that sacred tax-free cash cow in the Internal Revenue Code for over a century. It's what I call the laser fund. Laser means liquid asset safely earning returns. This 300-page book is full of charts, graphs, and explanations. You flip it over, and it also has 62 actual stories of how this is used, not only for retirement, but college funding, working capital for business, emergency funds, real estate management. You don't have to wait till retirement to access money. You can take out money in your 30s if you want. So this has way more flexibility. Simply go to laserfund.com. Contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost. I'll pay for the book and fire you out a copy. There's options there if you want to listen and learn, watch and learn. But here is to your brighter future on how to dramatically reduce your taxes.